but you have always been in and around the scene, so to speak,
Yeah.
right? And I think that in a lot of ways that helps define relationships, right? So if we look back and we say, okay, who were you spending your time with as you were going through those developmental years, right? As a young pup, and then growing up, making your friends that you probably still have lifetime relationships with. But the people that you spend the most time with in your life now versus those that you spent your time with then, what would you say the differences between those individuals are, whether it's economic, whether it's spiritual, or whether it's anything in between?
It's an interesting question. I think that everybody has a part of their life, a stepstone in their life where they're at a certain position. And I was in a position when I was, in my early teens, that my family was everything. My dad was everything. My grandparents were, my mom, my sisters. Then you transition into, you're going out on your own. I was out on my own when I was 18 years old. And, there's just, I don't know, that's an interesting question. I will tell you that I don't like surrounding myself with people who are lazy.
Mm-hmm.
And you can be very successful and be lazy.
There's some people in our sphere that we could name some names.
Yeah, you can be not very successful and have money problems, but be the most hardworking person you've ever met.
Mm-hmm.
So I wouldn't want to put it into a financial context.
Yeah.
I would put it more into I don't like stupid people and I don't like lazy people.
Mm-hmm.
Bottom line.
And would you say
I literally can't put up. It drives me bananas. Like when I've had salespeople in the past, and I'm like, hey, I asked you to do this task, call these people, do whatever the task is. I've asked you to do that. Oh, I just ran out of time yesterday.
Mm-hmm.
I go, do you have a family?
Mm-hmm.
No. I go, do you have kids? No. Do you have a wife? No. What do you do all day? Because I have 2 small children and a wife and a family, and I'm still managed to work my butt off and take care of everything I need to take care of to be successful. And you didn't have enough time in the day, and you have 3 loans closing next month.
Mm-hmm.
You should have time to run a marathon or do whatever it is. People make excuses for their laziness.
Do you still have those tough conversations? I mean, it's not tough on you. Sometimes it's tough on the person, receiving that, and then they have a choice on how to receive that message. Yeah,
they do. I found, Steve, and you may have found the same thing over the years. I still hate letting people go. Right, it's one of the hardest things you can do. But I also think it's one of the most brave and one of the best things you can do for some people. Some people have such an ethic of not quitting something that they work hard, they don't get anywhere with it because it's just not the right fit for them.
Yeah.
Right. And I've actually let people go because, listen, I'm doing you a favor.
Yeah. We both need this.
We both need this. Maybe this isn't the right mortgage company for you. Maybe this is not the right industry for you.
Maybe I'm not the right leader for you.
Maybe I'm not the right leader for you. So I'm not doing this because you're fired.
Yeah.
I'm just doing this because the chemistry doesn't work and it doesn't work, or you shouldn't be in this. And I'm actually going to do you a favor. And I've actually had a couple of people call me years later and say that was the best thing that ever happened to me. And one of them had just gone to another company, just different leadership style. He needed to be more micromanaged, and I don't micromanage people. And the other one had just completely left the industry and was the happiest person when I saw them ever.
Yeah.
So
there have been many a times, I'm sure, where I've had those days where I'm like, God, this industry is just kicking my ass. I need to
lately probably.
Well, the last couple of years, as you know, have just been magical from an economic and financial standpoint for our personal P&Ls, but from an emotional side, it's been very challenging, right?
Yeah.
With family and with kids and my situation, so it's it hasn't been an easy task, but I think in some ways, with this, with rates lifting the way that they have, and the way that they seem to be trending, it's given us more time, right, to be able to reflect on, I made it. Because we knew over the last couple of years, like, God, when is this phone going to stop ringing?
Yeah, I need a day off.
I need a day off.
I need an hour off.
I need to eat lunch.
Right.
I haven't eaten lunch in 3 days.
And now it's like, I haven't had my phone ring in 3 days.
So how do you handle that? From a leadership perspective,
from a coaching standpoint, I said, this is what you and I talked about. This is what we're doing right now, right? We're still keeping our names out there, doing the things that we should have been doing 2 years ago. And with my guys at the office, I preach, work on your CRM, that's your database management. Make sure that your clients know who you are. take the time to pick up the phone, talk to clients, do a review, a mortgage review, talk to your referral partners out there, develop the relationships, and also pay attention to your family,
Mhm,
right? Pay
mhm,
attention to your friends because you
mhm.
probably haven't done that very good job over the last couple of
Yep.
years. And please tell me you saved money over the last
Right,
2 years, right?
right,
And some
right.
of them haven't,
Yeah.
unfortunately.
Well, we went through that, when there have been times where, whether it's the mid 90s where the rates went from 14 to 9 to 8, 7, and you're refinancing people and it just seems like that they're just, the phone rings. And then you have times where,
To like 2020, 2001 after
mhm,
9/11,
yep, after the dot
and
com.
then the dot-com
Mhm,
happened right
mhm,
then too.
mhm.
That was a tough time. The
That
United
was.
States went into recession.
Yep,
Obviously, 2008,
yep,
2009, horribly, 95% of the people in our industry left the
yeah.
industry. We didn't.
And
We
then you
we
had
chugged it
it
through.
became more regulated, which I think was a good thing. It needed to be the case at the
Sometimes
time.
it's become some of that regulation now is showing its ugly head in the form of like the points and fees violations you can have that Fannie Mae and
Yep.
Freddie Mac put in place with a non-QM with a QM loan, where or prepayment penalties.
Mhm.
I mean, you've seen rate sheets right now, right? They go up to maybe 8.25%, but there's hardly ever any above par pricing where
Uh-huh.
you're getting money back because the investors, number one, know that if they close they let you close your borrower at 7.875%,
Yep.
right? That borrower is going to refinance in 2 years, and that
Mhm.
means that mortgage-backed security holder and the servicer who had
Mhm.
to pay a point to get
They're
this,
gonna be in the
and they're
red.
making about
Mhm.
30 basis points a year,
Mhm.
they're basically doing it for free. Not even free, they're giving money away
Yeah.
to do it. So that's not a good investment, and that's why we used to have prepayment penalties. So it would make the mortgage-backed security holder and the servicer whole if it was paid off within that
Well,
first
think
3
about
years.
that. Almost all commercial loans have prepayment
Yes, they
penalties.
do. Like there's we have some non-QM loans that
Mhm.
do have, but that's the reason. It's
Yeah.
because if you
You
want
have to
to
be
have
profitable.
if you want liquidity in the interest rate market and the mortgage market, if you
Yeah.
want liquidity and money enough to be able to finance homes all across the state for for the whole United States, which is trillion of dollars, right?
Mhm.
If you want that liquidity there, the liquidity comes from Wall Street and it comes from the individual investors and it comes from the institutional investors who buy mortgage-backed securities. And if they know that if they buy a mortgage-backed security pool full of 7s and 8% mortgages,
Mhm. Mhm.
it's going to be worthless in 2 years when rates come back
Yeah.
down,
Yeah.
right?
Yeah.
And because they don't have to come that far, if they
1
came down
point.
to six
Yeah.
percent from 7.5, right? People are going to refinance, and they've lost all their money. In fact, they've lost probably maybe another 50% of what they put into it. I mean, it's a
No,
big
it
deal.
is, and you being an entrepreneur, myself included, us, running our P&Ls for many years, we understand that.
Yeah.
From a loan officer perspective, what percentage of loan officers do you think even comprehend that or choose to go down that road to learn about it? Because that's important to
Almost
understand how your
none.
industry
Almost
works.
none.
No,
They don't.
no.
They don't understand how the actual mortgage market works. They don't understand that there is the loan originator, right? When we fund as a non-depository bank, we fund that.
Mhm, mhm.
But then we take that and we're going to sell that loan to the servicer who's going to pay us a point or whatever for the
Yep,
servicing release premium, right? Now that servicer actually has the loan that they're servicing and they get paid. They can take about 30 basis points on average, right? You make
mhm.
on a loan, but they had to pay a point to the bank who originated it,
Yep,
right?
mhm.
So if they're only making 30 basis points, that's a little over 3 years before they even break even,
Yep,
right?
mhm.
And then there's the mortgage-backed security holder, the security behind it, right?
Which could be a
Those
big insurance company,
are institution
institutional,
like a
California
teachers,
Teachers Credit
right?
retirement system.
Are
Yep,
just Warren Buffett or
yep,
whoever maybe
yep.
or you could do
It
it,
could be
right? You
us.
could invest in
Maybe that's
and
what we should do. No,
well, not
no
right
money in
now.
it.
No, I'm not getting in bonds right now. Um, uh, so there's and then those mortgage-backed securities they're having they want to make money. That's why they invest, and
Mhm.
so that's why you see the spread between the 10-year the Treasury bonds and mortgage-backed securities is so big right now,
Mhm.
is because more people are investing in the bonds because they're afraid of early prepayment penalties. I'm sorry, early prepayments (EPOs) on the mortgage-backed securities because we know rates come down, they go back up. They
Yep.
come down, they go back up. And there's actually, if there's a recession on the horizon, which I believe there probably is, um, rates will start to come down a
They
little
will.
bit, right?
Yeah.
Because the Fed has been, I think, a little too heavy-handed on
Mhm.
their cuts. They're going to do another 75 basis points on November 2nd. But I think some good economic news is going to be released in
Mhm.
October when it comes to inflation.
Mhm.
For the month over month CPI, they're going to be replacing last October's with this October's, and last October was 0.6%.
Mhm.
If you so there's if you add it all up, it comes out to like 6.7% year over year inflation. But I think it's going to be replaced by a lot smaller number, which will put that average back down a little bit, which
Mhm.
I think will help the Fed say, okay, what we're doing is working. We're driving inflation down. So that comes out the 10th, I believe, of November
Mhm.
2022. So
Mhm.
we'll have to see. And if anybody's watching this podcast after that, they can check my work on
That's
that. So
right.
I'm actually, so I'll give you a prediction.
Yeah.
I think by March of 2023, they will probably see rates back down in the fives.
I would expect that myself, yeah.
And
And
I would
maybe
want
even
them to stay there
yeah.
because that will help with the liquidity in the mortgage
Mhm.
market,
Mhm.
right?
And it's healthy.
It's healthy and
Mhm.
it's a healthy growth, right?
Mhm.
Uh, we don't be careful what you wish for. If you have rates back down at 2.5%,
Yeah.
it's because there's another pandemic,
Mhm.
there's a bad recession,
Mhm.
or there's a war.
Mhm.
We don't want any of those,
Mm.
right? We
Yeah.
want good, slow economic growth.
Rates at 2 and 3% are not healthy for really anyone,
They're not
ultimately.
because it drives demand too,
Mhm.
right?
Mhm.
And you saw the appreciation we saw in Austin in
Mhm.
2021 is what is it,
Mhm.
35%
It's yeah.
average?
Yeah.
That's crazy.
Yeah, it's
It's
not
not
sustainable.
sustainable. It's
Mm-mm.
not, and it won't work. I love Austin though,
Mhm.
and people ask me, but how's Austin going to do in a recession? How is
Mhm.
Austin, doing with all this? And the business has slowed down.
Mhm.
It's still better than most years.
Mhm.
We're at almost 4 months worth of inventory. Still a buyer's market.
That's yeah. 4
And,
months is not a
and
lot of
this is, I
inventory.
think, this is an opportunity for
Mhm.
people too, right?
Mhm.